Okay, let me start the webinar. Good day to one and all. This is Dr. Sivaraman of iknowindices.com, and everybody is waiting for the non-farm payroll outcome. So we know that it is going to be a trigger for the market to set some quick moves. And there are two types of traders in the market. One, they want to know the outcome of non-farm payroll, and where the market is going to set their trend, later on try to enter into the market. The other set of people, they are interested in capturing profit during such volatile moves the players do during and after that of the non-farm payroll release. So I thought that I can give the spike trade calls, that is how exactly reading the intentions of the player we'll be able to take the position and then maximize the profit after that of the event. So I'll be giving the pre-non-farm payroll event between 11 and 11:30 GMT, and I'll also explain why I'm taking the positions and what are the expectations. And my forecast is a statistical algorithm is used to derive the forecast, and I fine-tune the forecast using the market reading technique. And in order to limit the risk and maximize the profit, I use the trading technique. I'll explain how exactly in live calls such things are implemented. Then by 14:30 to 14:45 for 15 minutes, after that of the event, when the market has shown the reactions to that of the release of the non-farm payroll, what happened to our trades, and also give the review with regard to the market. Now, if you look into the market is shown in the form of a live market quote page. Here you come across the 4 majors and 2 commodity pairs. Then you find Euro, GBP are showing the negative net change, and they are in red in color. Then USD and USD CHF are in green color. So that means they are making the USD gaining move. But when you look into that of Canadian dollar, which is showing a negative net change, that means it is showing USD weakening move. Australian dollar is showing positive net change, again USD weakening move. So that means those currencies are stronger than US dollar. That's what it means when I say that it's USD weakening move. So the majors are showing the USD gaining move, but the commodities are showing the USD weakening moves. And yesterday I was giving, before that of the ECB press conference, the spike trade call, and I was explaining that the majors were showing the USD weakening move, and the commodities were showing the USD gaining move. Exactly opposite they are trying to do now. And these are all the net changes from that of the previous day close. After that of the previous day close, Euro has come down about 12 pips. That's what it refers to at the current time. So we look into that of the live market quote page, and tick by tick, we'll be able to see the price action, and we'll be able to understand what the players are trying to do it, rather than using a 5 minutes chart or a 10 minutes chart or 30 minutes chart, etc., where after the formation, after the completion of 30 minutes or 5 minutes, a candle is being formed. Instead, every pip movement in the 4th decimal level, we'll be able to see in the live market quote page. But for that, we need to have certain amount of perception. We should have certain amount of the memory power. That is, we should be able to remember the levels, and then it is easy for us to do it. Because we want to avoid remembering the levels, so for our convenience, we try to look into the chart and say that, okay, yesterday level was this and today's level was this, and try to connect it. But in what way you can connect it? Because Yesterday's level is meant for yesterday's traders' pending position. The players have made the move. And today's move is totally different. It all depends upon how the traders are going to commit the position. Accordingly, the players are going to make the moves in the market and trap the traders. So if predominant of the traders are sellers, they will drop. If the predominant, they will rise. If predominant of the traders are short, then they will rise the market. So ultimately, players come into the market in order to make specific moves to earn money. So their main objective is to earn money. So when they are interested in making money, not interested in showing levels, why we should show interest to that of the levels? We should also show interest to make money from that of the market. So if that is the case, how exactly we should go about? So I have identified a trading system, and which is used for about 19 years so far, and consistently I'm able to see that it is able to reflect upon the market. So first of all, the forecast. So I have used the statistically derived forecast, and that says that today, so date has to be changed. That is 3rd June, Friday. Sorry, I forgot to change it. Japanese session, they are expected to make the swing and slide, and then European session, early session, they are expected to swing near low after the slide, and then after that of the non-farm payroll, that is going to be released by 12:30 GMT, 30 minutes prior to the close of the European session. They are expected to make an upward move. Then afterwards, they are expected to swing again during the gap time between that of the European and the US session for 30 minutes, 13 to 13:30 GMT, and 13:30 to 15 GMT, they will be making another swing in the market in order to confuse the traders when they wanted to commit sell and buy, and they will try to make opposite move and then really give the confusion for the traders to commit wrong position emotionally. They create the market sentiment and the traders commit position. Then later on, they act against that of the market sentiment so that the traders get trapped. The players are able to earn money. So when they want to make huge money from that of the market, then predominant of the traders they have to trap so that the traders, when they lose, that becomes the money of the players. So this is the game. In this, we need to understand how we are going to read the intentions of the players. So the forecast says, based on various factors, that they are expected to make the rise in the market after that of the non-farm payroll. The non-farm payroll is going to be announced by 12:30 GMT. The non-farm payroll data, probably the previous one and the expected and the actuals. So all those numbers, probably people will give importance. Ultimately, I give importance to that of what they are going to do, whether they are going to drop the market or rise the market. That is ultimately going to give me the earning potency. Then also the hourly, average hourly earning and the unemployment rate. See, invariably nowadays what they are doing it, even though the non-farm payroll might be positive or negative, then the players say that no, average hourly earning is not good, or the unemployment rate is still there high, and simply they give alternative and make whips or moves in the market. So all these attributes are used to make whips or moves in the market, nothing more than that. A whips or move is a quick upward or a quick downward to start with, and the opposite later on. So we need to know in which way they are going to make it. As I have been telling all along, the players are cunning. If you want to earn money from that other market, that is, you want the money to multiply and money to make further money without putting into effort, the only method by which money can multiply is cunningness. So they will make a cunning move before that of the data release. That will indicate, okay, they are making a dip before that of the data release. Okay, they wanted to rise after that. We'll be able to read it that way. So they are expected to make a quick false dip before that of 12:30 GMT and swing and spike up after that of the release. That is what the forecast says. Now we come to that of the fine tuning of the forecast using the market trading technique. Market trading technique is nothing but we note down the initial lows and the highs, what they set around 3:30 GMT, and that they use it for their communication purpose. So we also try to use it in the same way. So find out in which direction they wanted to make the moves in the market. So formed the initial low 1.1147, and they came down from there to 1.1137, holding below that. But they are not breached the new low formed. The high is okay. They just breached 2 pips. Then in the case of GBP, they came down close. Even just about 5 minutes back, they came down to 44.07, but they are not breached 44. And the high is 44.21. They breached the high and came down. So they just take out the stops on the higher side and made a small dip. And this way, they try to give that impression to the traders that Euro and GBP are going to fall. Because if they don't sustain, the charts will indicate that there is going to be a red candle formation, and thereby there could be further drop. So in order to make the chart to give a wrong impression to the traders, they make such small swings when the volume is very low, because all along throughout the day, the spread between the high and the low is about 20-25 pips in all the currencies. Then in the case of yen, they just breached the low 108.75, came down to 108.50, and then the high was not taken out. And they made the downward stop and gone above and holding there. So that indicates that they wanted to slowly gain the levels also in the case of USDM. Then in the case of CHF, they are just making a small consolidation of about 15 pips, so let us not go into that. The Canadian dollar also, they are making a small consolidation, breaking low on the high nominally. And Australian dollar also, they just made a quick upward move above 72.38 to 72.63 and then come down. So either way stoppings, they are done it in the case of the commodity pairs. So let us focus on Euro, GBP and USD yen. And there they are expected to, so they are likely to gain the level in the case of GBP to start with, because they are not breached the low. And in the case of Euro, they are just breached the initial low and staying below there for more than 30 minutes. That means up to 2 hours they will hold. And after that of the non-farm payroll, they are expected to make an upward spike. And also here you find Euro is making 12 pips negative net change, whereas GBP is showing almost flat. So they are expected to gain the level in the case of GBP to start with, followed by that of Euro. And in the case of yen, they are expected to make a small dip to start with when Euro and GBP are gaining the level, indicating that it is totally a USD weakening move. And later on, they are expected to gain the level in the case of USD and also during the US session, and say that yen is behaving differently for that non-farm payroll. And so ultimately, they give attribute for every currency move, but we need to understand why they are making such moves. All the moves are purposeful. That means they know very well where the traders are trapped. Accordingly, they trap the traders and earn money. So we need to understand that even though the forecasts say that there is going to be a rise, but still, if all traders turn long, then the players don't have a philanthropic idea of giving profit to everybody. So in that case, they could make a drop and hit all the stops before making further rise. So we should be prepared for such event. So how exactly we can do that? Now, this is how my trade plan will be. So I will take an entry around 1.1137 in the case of Euro, closer to that of the low, and keep 1.1100 as the hedge order, around 37 pips below. So hedge is an order which is placed in some of the platform where the hedging facility is available. So if the market suddenly drops and breach this level and go below, I will take a sell position here against the buy position without additional margin, and then my equity will not erode even if they go to 1.10. So I will only block 30 pips equivalent margin. And once the market hedges me, I just watch for about 10 to 30 minutes. The hedging is not making profit. I understand that they just hit the stop or the hedge during stop and before making a rise. So it is not making profit. My sell position is not making profit. So I close the sell position in 10 minutes and keep another hedge order to limit further risk. And then once they start gaining the level, I keep stop at entry. So I use the hedge instead of stop in such condition. Then later on, when they start gaining it, I know very well they are expected to gain about 100 to 150 pips during the non-farm payroll, even depending upon the volume of traders' participation. So I keep a tentative exit level, keeping about 100 pips above. Then subsequently keep stop at entry, so that if they further make a drop during the US session, I don't lose anything. I only lose the position. Then when they gain, I will use 15 pips trailing stop during the session, not during the gap time. Because gap time, they will make a false move of dip before making further rise from that of 1330 GMT, the US session. So I will keep the trailing stop during the session in a profit-making position and also see that how far they are rising it. And if they don't come anywhere near, then I will try to tighten this particular exit to that of the closer to that of the market level, away around 15 to 20 pips. And this will also be away about 15 to 20 pips on the lower side of the market. So on the lower side of the market, I will be having the trailing stop. On the higher side of the market, I will be having the take profit order. So that way, the market can hit either my trailing stop or my take profit order, so that I'll be able to really maximize the profit. So I don't predetermine the level and keep that exit. And then subsequently, when the market goes further upward, I don't repent. Instead, I will try to capture the maximum profit out of such moves by using a trailing stop. You know, the players are so quick in making moves in the market, and your position might be making a very good profit. Suppose you have taken a buy, the market might show about 100 pips profit in that. So you will be really elated and say that, oh God, I am just seeing 100 pips profit in a matter of about 3 seconds or 3 minutes. Then in another 5 minutes, it might be making about 50 pips loss. That is how they make the quick move. Before you blink, they will show a different price. And so you have to use the trailing stop to do that. And invariably, the platforms will say that the market has jumped, so we could not do anything. So you have to accept the loss. That is how they will tell you. So you should be prepared for that. And if you use the hedge, most likely the platform fill the hedge. Or if you use the exit or the predetermined orders, then they fill it mostly. In the case of JBP, they could make a brief downward stop and just to create the market sentiment. See, slowly they are just handling on the downside and all by showing negative net change. So they could make a brief downward stop and for about 10-15 minutes, 15 pips, and then start gaining the level. So here they have already done the breaching the initial low. In the case of GBP, they have not done it. So there might be a possibility. So keep this as the a mental entry level and just see how far they are coming down. Accordingly, you take a buy, and definitely they will be making about 100 to 150 pips rise. So keep 150 pips away your exit order and keep about 40-45 pips below the hedge order to limit the risk. In the case of Australian dollar also, just 70 to 22 with about 30-40 pips hedge order, and the take profit order Australian dollar. They are expected to make a quick upward spike, and that could make a good money because they are showing it is in the positive net change. So there is a great possibility that since they've done a prolonged consolidation, they could make an upward spike. And you might be asking in what way non-farm payroll is going to affect Australian dollar. It is not a question of any currency related. It is a question of how the traders have got the positions. Accordingly, they make the moves. Sometimes they make big moves in the case of the majors in order to trap the traders in the crosses. And that is why you would have seen many times that they make a quick drop in the case of euro and rise in the case of GBP, or rise in the case of euro and drop in the case of GBP. You might be wondering why it is happening like that. That is to mainly handle euro GBP or the European crosses. So from time to time they make such contrarian move. So you should be able to identify that with the help of the live market code page, because this page shows clearly in what way they are making the moves in the market. Pip by pip, we'll be able to understand, and the net change will indicate clearly what they are trying to do is. Because we need to read their intentions, only then we'll be able to really and decisively enter into the market. And the hedge is just to avoid any element of risk, because we might be 90% or 95% correct, but still, in order to limit the risk, if the trade falls in the 5% category, then we should not say that no, it has only fallen in the 5% category. Otherwise, 95% I am correct. There is no point, or there is no benefit by talking like that. Ultimately, what is more important is making money from that other market. So for it, you need to really understand that the market moves are to be captured correctly without much of a risk. So if there are any questions, you can ask me the questions. I'll answer those questions. Okay, there are questions. Did you make the review of yesterday's trade? Yes, I explained it during that of the Asian session live market analysis, what I gave this morning, and they made the negative move against the buy positions, and then subsequently euro was hedged and GBP was not, because that was around the same level. And then afterwards they made a quick upward move. We are able to book profit on the hedge side and a nominal loss on the buy side. That way we can close the position and make net profit. That is what I always say, that see, as long as we are human, we are bound to commit mistakes, knowingly or unknowingly. So we try our level best to find out what could be the possible moves. So all the chart study, fundamental study, everything is to predict the future. So when you are trying to predict the future, it is like predicting the weather. So there might be an element of risk involved in that. But we have to narrow down the risk, and we have to use the trading strategies to see that we are not trapped during the risk time. If your idea is to buy euro and GBP, Australian dollar, buy near low, which is pretty much selling greenback. Yeah, it is very much selling greenback. Why buy USD yen? Okay, this is what you are telling. Now see, greenback, that is, you are buying euro and GBP near the low. That means we expect US dollar to weaken. It doesn't mean that US dollar is going to weaken against all currencies. All along I have been telling the players make contrarian move. Now USD yen is making 1 pip negative net change, along with that of GBP 4 pips negative net change. So yen is showing the USD weakening move. GBP is showing USD gaining move. That's called contrarian move. So you assume that all currencies will make only USD weakening or USD gaining move. is wrong, because you look into the currencies individually. If you look into that of the live market quote page and see all the currencies simultaneously, then you will be able to understand, okay, they are making contrarian moves among the majors of the commodity pairs in order to handle the crosses. So by making a downward move in USD and downward move in GBP, they are able to drop Euro GBP considerably. That is the purpose. So I know very well they are going to make an upward contrarian move after this. Rise Euro, rise GBP, as well as rise USDN. So we need to understand and take accordingly the positions. Then, is it not the fundamentals of the euro not enough good? So if you think all the time that fundamental is going to work, you know very well in the market from time to time, people say that fundamentally euro has to be weak, but technically because of oversold condition it has gone up. So what do you say for such explanations? So ultimately keep in mind the players create all sentiments by using fundamentals. Then they say that, okay, fundamentally euro has to be weak, but technically it was oversold, so it has shooted up. But that means what? Many traders have taken sell position because euro was looking very weak and heavy, not able to go up. So they take the sell position. So if the players rise, what will happen? All will come for short covering. So that is the way the players can make money using the bank arm. You will not be able to move the market using your live market, using your trading platform. Only the banks can do that. Then you ask for the review because the euro position is negative. So I wanted to understand your methodology. See, basically, as I told you, I'll be giving I only ask you to try it in a demo trading platform. On 8th of June, I'll be giving 3 hours webinar explaining how exactly I take the decisions with regard to the entry, exit, and also hedge, etc. using the live market. At that time, probably if you attend, you will be able to get it because in a short notice, and I'll not be able to explain. And it is not the question of negative and positive we are trying to take it. We try to find out what sort of move they are doing it and accordingly take positions. As I explained that they have made a brief downward move as an extended move on the downside before making an upward move. That because they are not breached the new low, outperforming it. Then reality test. Okay. Because it is USD risk event, the assumption is for green pack move across the board. Okay. Now, if you say that the data is pertinent to US dollar, so all currencies are expected to show either USD weakening or the USD gaining move. As I told you, that they are showing the negative net change as well as the positive net change as a contrarian move. So that indicate that they wanted to make contrarian move after the data release. So we assume and accordingly we take positions, but the players are very smart. After the traders commit position, they make the moves. If all traders have taken the buy position, they push euro downward fearlessly because they know very well nobody will come for bottom fishing because already people have got the buy position. They have no other option than to liquidate. So that is how they handle the market. Okay, so we need to understand how decisively they are rising and dropping the market, all because they get the first-hand information. So we try to read their intentions indirectly using technicals and fundamentals, but using the live market code page to read their intentions, because whatever be the intention, they have to express it in the market. And initially, they express the cunning move. So that cunning move, we try to capture and try to enter into the market so that we are in a position to earn. Still, we do not want to take unlimited risk. So we use the hedge order to limit the risk. If we use the stop, what happens? They simply close our position. Instead, we keep the hedge order so that we use the trading strategy to earn during either way moves of the market, so that we will have on at the end of the day the net profit. Okay. So I take this opportunity to thank FX Street for the facilities provided and for you people who attended here and listened to the webinar. I'll come back by 14:30 GMT and explain to you the outcome of these trade calls so that you'll be able to understand how fearlessly we can read the intentions of the players and trade along with them. Thank you one and all. See you by 14:30 GMT. Wish you all the best.